love the channel and find it useful in becoming a happy retiree. Subscribe today. This is a call from Seth in Tequila. Seth, what's going on? You have a question about taxes?
I do, and this might lead into what you're about to talk about. The tax code right now has been released, or at least a rewrite of it, and I know there are certain aspects of it that might change after the Senate's done with it, and then, of course, the House of Representatives, again, if modifications are made, not to mention all the lobbyists and special interest groups. But in your opinion, do you believe there's any aspect of this release that might actually survive all those modifications and still remain relatively intact as far as how it was presented the other day by Speaker Ryan?
So I do in a lot of respects, because I think that, let's not say, I'm not going to go into the political side of this, but as I look through this, it's not as dramatic as we might think. Now, you might if you live in a state like New York, you say, wait a minute, you're getting rid of my state and local tax deductions. That's pretty legitimate to me, and that really hurts me. So some of it is a big deal, but on the surface here, the way I see it for individuals, Seth, is that it's slightly net positive for most people. And so if you think about Congress and you think about how our congressional leaders, they vote for what to get more votes. So let's just say let's look at it in that context. And I think that the vast majority of the population is going to support this and want this, because pretty much helps almost every category. So I do think it gets through. I do think, and I was going to talk about this today, so this is a great lead-in question. So thank you, Seth, by the way, and thanks for listening to Money Matters. I do think that there's more weighting towards the corporate side of tax changes than the individual. And I look at this as a bill or a proposal that has a little bit of something for everybody. It's a whole lot to the corporate world. It's a little bit for you and me as an individual. But as an investor, because so much is changing on the corporate side, or there's more dramatic change on the corporate side, it should be good for businesses in America. And as an investor, that's really where I want to place my bets, meaning that this is good for companies. That means it's good for company earnings. That means it's good for stocks. That's where I see an unsung benefit to all of this as an investor in America. So let's go through some of these changes. And again, I look at this as, to some extent, something in it for everybody, at least a little bit. We've talked about the corporate side of it. Here's why it's such a big deal for corporations. Remember, today the tax rate's 35% for corporations. This bill would take it all the way down to 20%. That would create billions of dollars of new profits for every company that's publicly traded that you and I invest in, or almost every company. Now, let's look at it in reality. Most companies already have an effective tax rate that's lower than 35%. Right now, it's around 27% is the average effective rate. And I don't think that everything, to Seth's question, is going to happen to the letter in the proposal. So let's say there's some compromise and it ends up at 23%. We're still talking about a real positive change for company earnings. So I think that really benefits investors more than anybody. Earnings tick up, stock markets tick up, investors win. So think of it from that perspective, Seth. Even though the corporation wins, if you choose and put the emphasis on being an investor, that's a benefit for individuals. Number two, reading through this, I didn't even realize how big of a number this was, but there's over 5 million people in America, or taxpayers, families, that get hit with AMT, alternative minimum tax. And as soon as I say alternative minimum tax, I know you just literally eyes glazed over. Let's go to sleep. Let's change the channel. Don't change the channel, because you very likely are in this range if you're listening to WSB radio. This hits people in that $120,000 income range all the way up to the $500,000 range. You effectively have to run your taxes twice, and if the AMT version of it makes you pay more in tax, that's the tax you have to pay. So you may not even know you're paying AMT, and you might be paying AMT. You could be in, let's say, and let me give you an example of this. It imposes a higher tax rate for some reason, or if for some reason your overall income ends up weighted to a lower rate. For instance, let me give you an example. let's say you have 150,000 in regular wage income, but then you sell a piece of property or a house and you get $250,000 from that, and it just gets taxed at long-term capital gains, which is a lower rate of 20%. The tax code will now say, too bad, you can't have so much of your income taxed at such a low rate. So then, boom, AMT kicks in, you got to pay more. That's what hits so many Americans. And it may not happen every year, but it could happen in any given year if you have some sort of transaction. This proposal takes away AMT. Could be a very big deal for a lot of Americans. So here's a couple other examples. So I think AMT, which hits a lot more folks than you might think, 5.2 million or more. That's first of all. Number two, the second or the third piece of this. So number one on this is, I think the corporate side of this is a big deal. AMT number two is a very big deal going away. Three, the lower taxes on small business owners, a very big deal. So a 25% pass-through tax. So LLCs, S corps, you name it. Think of really almost any small business owner might very well be an S corp or some sort of LLC, and now subject to what could be a lower tax rate. So if they're in a 30 tax bracket, because you're a small business owner, now you drop to a 25 tax bracket. That could be a very big deal. Number four, charitable deductions, they get up to 60% from 50% of your adjusted gross income. Again, that's a big deal. The plan slashes a lot of itemized deductions, this new GOP bill, but kind of sweetens the pot on charitable deductions. The number five on my list here, the SALT deduction. SALT stands for state and local tax deductions. Instead of going away, the compromise here is that the bill will allow you to keep up to $10,000 worth of these deductions. Now, let me give you an example of this. Let's say you're in a high tax state with a 10% state income tax. Here in Georgia, we're at 6%. Let's just say 10% for round numbers. You make $400,000. You'd pay $40,000 in state and local taxes. Actually, probably more like 50 or 60 if you put the local tax piece of it in. So now you can take that deduction and you'd be able to deduct 50, 60 grand off your taxes. That saves you 10, 15,000. That's a big deal. Or maybe even more, maybe 20,000. Now, instead of taking that full 50 or 60,000 as deduction, you could only take a full of 10, so that you might only save a third of that. You might only save 3,000. So as you can imagine, that can be pretty dramatic if you're a high earner in a high tax state if it goes away. The mortgage interest is a big deal. That's a surprising change. I did not think that this would end up getting introduced in the bill, but it certainly has. Here's the bottom line. There's a little in this bill for everybody. Some sacred cows getting put to the test, SALT, the change in mortgage interest deductions, but the elimination of AMT is a big deal, could be a big help for millions of families. The corporate side, with lower overall rates, is a big deal for jobs and earnings and investors. So don't redo your budget for this plan. It might only save you a couple $100, maybe $1,000. Do put more emphasis on investing over the next 10 years, as this tax overall could end up benefiting investors in U.S. businesses more than anyone. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.